Next up, Arista Networks, ticker ANET, one of my favorites and one of my favorite supply constraints in the AI supply chain. Okay, so all year we've been watching where in the AI supply chain, from the semiconductors, from the semiconductor equipment, all the way through the data centers that run the cloud data centers that all that AI goes through. Where are the supply constraints, and what is pushing up the prices for those vendors there? We've seen Micron Technology, ticker MU, boom, like 400% over the last year, just because they have such a supply constraint in those memory chips that the company is able to get pretty much any price it wants out of its memory components. We're also looking here at networking equipment, one of the biggest supply constraints after probably power and those memory chips. Arista designs and sells the networking solution. So that's the equipment and the software that helps move that data around a data center. So not only from the user into the servers and into the GPU chips by NVIDIA, but also from storage back into those chips as well as back into storage. So very important how that data is moved back and forth through networking equipment, through those networking pipelines that are in such short supply. And again, that supply shortage on the equipment is just driving 27% revenue growth for this company. And we see Arista's competitive advantage over its peers in its EOS platform, which delivers the kind of performance and programmability that AI cloud centers need, with that high focus on high speed switching that has created that competitive advantage. For my money, folks, there is really only three companies in this networking space that I'm watching for this networking supply shortage that I think have this kind of a competitive advantage. That is Arista Networks here, ticker ANET, Broadcom, AVGO, which probably other than maybe NVIDIA, there's no other company that has so many component inputs into a data center than Broadcom. And then Astera Labs, ticker ALAB. All three of them have these competitive advantages in their technology that makes them a force in that AI data center build out theme. Well, we can see here a long list in the information technology sector, a lot of industries there that I looked at. Here within communications equipment, we had Arista Networks and Ubiquiti. So Arista Networks, ticker ANET, and Ubiquiti, ticker UI. Arista there with a 64% gross margin, 43% operating margin, well above even Ubiquiti, the next highest up. So we had very much a higher operating margin, operating profitability. Next, I'm going to show you why that is so important. But here we also see that it has been expanding. Again, so important here. Not only that it is dominating in this kind of profitability within the industry, but that it is getting even more efficient. A lot of management, they're going to get to that top profitability within their industry, and then they're going to let off a little bit. They're going to start investing more in growth and R&D, and they'll let some of those operating expenses run away, and they're not going to be improving their operating profitability. So, Arista, they could have been content with 35% operating profitability here in 2022, but they grew it to 43%. So this is not only the top for operating profitability within its industry, but also getting more efficient and really pushing that further. We are just getting started with our perfect portfolio of 11 stocks, but I want to show you how I put this together, why it's so important, and why it's so much more than just each stock pick. I highlighted AppLovin, ticker APP, as the top stock in that software video that I'll link to in the description below. Again, look there for more detail on why we're picking from each sector, each industry, and how to put this list together on your own. That was a couple of weeks ago with the stock up 70% over the last year. Now, this ad tech company's core business is in its Axon platform that helps developers monetize users through its ads. The platform consistently delivers better CPA for its advertisers and higher CPMs for publishers, making it a win-win for both sides of its customer base. Now, scale also matters here, and AppLovin is building to a customer base that just cannot be matched for this kind of competitive advantage that we're looking at. And here in the software space, we did have AppLovin, ticker APP, and Fair Isaac Corporation, ticker FICO. Kind of interesting there in the software space. AppLovin with its almost 60% operating margin, which is well above most other companies. Now, software technology, those tend to have higher operating margins, higher profitability margins than most other companies because, of course, they don't have a lot of the inputs, a lot of the raw materials that they need. It's more of a knowledge economy industry or sector, but they do have higher R&D expenses, higher staffing expenses. So this is where we get this 60% operating margin, though, here for AppLovin. And this is built from a 19% operating margin there pre-pandemic, so 19% operating profitability there in 2019, all the way to 60% here over the last year. 22% revenue growth, so very strong revenue growth, converting all of that revenue, 60% of that revenue into operating profits. Okay, so $6 out of every $10 of revenue is going into operating profits for this company. And here, Netflix, ticker NFLX, has fallen like a rock since that $130 peak there in last July, even record subscriber numbers couldn't help it in last month's earnings. But folks, this is the dominant leader in streaming. Okay, there's a YouTube has higher streaming audience. Disney, I think, has a higher streaming audience, but Netflix has some real competitive advantages that I think are going to push growth for it, as well as just the valuation on the stock right now, down from $130 there in July. This stock is now in deep value territory for the kind of growth that we're going to see. Again, if we look at the top players in streaming here, with the HBO assets, Netflix is the third largest streamer by those Nielsen shares and has a huge competitive advantage in its international production. Okay, being able to create those blockbusters like Squid Games out of Korea and elsewhere for a fraction of the cost. Okay, if you don't watch Netflix or if you're not watching some of these international shows, they are supremely addictive. Okay, Netflix is able to produce these TV shows, these series over in other countries, Korea being one of the big ones, but also Brazil, Latin America is very popular, creating these productions for a fraction of the cost that they would have to pay here in the United States, giving them a competitive advantage against some of these other producers, the Walt Disney Company, NBC Universal, Fox, Paramount, that all create most of their productions, most of their series here in the United States and have to pay those higher costs. And we see that advantage here in the profitability. We've got 3 entertainment companies there in the data there. Netflix is actually one of the lower ones for margin of these 3, but I like it because it does have those other competitive advantages over NetEase here and Tencent. Really didn't want to get into any Chinese ADRs or Chinese companies here. I wanted to keep this a little bit safer than some of those geopolitical risks that we see in those Chinese companies. But Netflix, 29% operating margin. That is well above the 17% in 2022 and the 12% in 2019. So again, like a lot of these companies I'm picking out, they are getting very much more profitable, even from high profitability margins in the past, but getting very efficient at converting those sales. 13% revenue growth, therefore, Netflix expected this year. And while you only see those 3 in that short list of 60 stocks, we can compare that against some of these other operating margins here in the entertainment industry. So comparing against that almost 30% operating margin, operating profitability by Netflix, you see some of the other competitors here in this space. You see 14% for Walt Disney, Spotify 12%, Warner Music Group 10%, Liberty Media there around 10%. So that really puts this operating profitability, this competitive advantage into perspective here. Almost 3 times operating margin, almost 3 times operating profitability, that 30%. And it's not just that this company is converting so many more sales dollars into operating profit. It is why it's able to do that. Okay, again, that is a clue to the competitive advantages that Netflix has in that international production that is so much more cost effective, and it's just its dominance in streaming.
Starting with number 1, and that one would be Amazon. Look, this one has been on my DCA list here for really since last year. And I've just been quietly DCAing into it during that entire time, basically a year and a half now. It feels very, very similar to the Google situation where just Wall Street wants to disrespect it, put out narratives that actually don't match what's happening on earnings or anything else of that nature. That's why you have to listen to earnings calls. Make sure you were doing that every single time. But hey, you saw it with Google, and then magically out of nowhere, they went from the laggard and behind and they're dying to the leader all in the span of like 2 weeks. And you got a massive run up in the stock there. Doing the same exact thing. Feels very, very similar to Amazon. Great business, great company. You want to keep giving me stupid discounts on great companies, Wall Street? I will keep right on buying. Keep it that simple. So stock number 2 is Meta. I don't know, guys. Another company that just had unbelievable earnings. Not as good as Palantir, so I won't put it up in that category, but it was definitely great earnings, great performance, and Wall Street just wants to beat it down. This seems to be the pattern with Meta overall, right? It kind of gets in favor, runs up to fair value, maybe even a little bit above fair value, and then Wall Street gets dumb again and dumps it for reasons. I got it. Nobody really likes Zuck. I don't like him either, but I can't say the guy doesn't run a great business, a massive, massive cash flowing business with tons of levers to pull to bring in even more billions of dollars to the bottom line anytime he wants. So yeah, he's got a big CapEx year coming in regards to AI spend. I don't freaking care because he can turn right around and pay for all of it tomorrow, just simply by pulling a few levers of monetization. It's just a great, very, very well run business. I love everything that they're doing. I actually think they're working on something in regards to AI that's just kind of floating underneath the radar right now and isn't picking up a lot of traction. So hey, you guys want to get this down? It's getting close to my price target. I'm absolutely going to start buying that stock as soon as it gets there. Not a problem. I have zero concerns with this stock, and it's it just takes a couple of days of Wall Street being silly for me to be able to add this stock. So it's absolutely on my list of stocks to buy this month. And the final stock on this list would be SoFi. Don't worry, we'll talk about that other stock here in just a second, but let's get to the last stock that I'm buying this month, and that one would be SoFi. I don't know what else people want, man. Great earnings, great guidance, great everything across the board, and Wall Street just beats it down once again. My dream scenario there. I understand some folks, I still saw it in the comment section about dilution and stuff like that. I guess, I don't know. Some folks just don't understand it. That's okay. The only folks that seem to have a problem with it are retail investors. I don't know, whatever. It's part of high growth companies that are trying to grow. That's exactly what they do. Take a look at anybody's journey. Take a look at every single company on this list's journey that we talked about so far. Same exact thing. So I have no concerns there. Everything about this was a great, incredible earnings call. And of course, Wall Street's beating it down again. You got to remember, guys, especially with SoFi, it is an early stage growth company, which means it is still firmly trader controlled right now, okay? Those are facts with the stock, which means you're not going to just go from over here trader controlled all the way over here to a nice stable stock. It's just not going to happen at this stage. This takes years for that to happen over time. Even if they make them S&P this year, even if a lot of other things continue to go great, this journey takes time. It takes years, okay? Which means we're going to get large fluctuations in the stock that don't make sense. Guess what? I don't freaking care. Didn't make sense when it was down at $4. Didn't make sense last year at $9, right? None of that stuff made sense. You know, Palantir being down at 20 in 2024 made no sense. No sense at all whatsoever. Palantir being down at 6, or Meta being down at 80 during that time, or Amazon being down at 80 in 2022. I mean, just none of that stuff makes sense. My job is not to make sense of Wall Street. My job is to identify when Wall Street gets stupid and I have great fundamentals and I'm getting underpriced shares, and I jump in and I take advantage of those shares. That is how you make fortunes in the stock market as a long-term buy and hold investor. Hey, looks like we might very well getting that opportunity with SoFi again. The time to buy SoFi is not whenever it's at 28, 30, 32, going to the moon, and everybody's saying it's going to 75 or 85 or 125, next week or something like that. That's the wrong time to buy that sort of stock. But that's what people want to do, right? Silver. Didn't hear a thing about silver until it was at all-time highs. Crazy ridiculous. And that's when everybody wanted to buy it, to include even in my group. You see all exactly what happened just very, very shortly after everybody wanted it, down in the toilet. Is what it is, guys. You've got to learn to avoid those situations and stick to fundamentals in the end. Now,